recording real quick. All right. So as you guys are well aware, Nissan has made the decision to change record keepers for the 401k plan. And of course, they are moving from Vanguard, where it's been for many years, over to Voya now. And so with that comes some questions, certainly, but also some new opportunities. And that's what we want to explore today is kind of what some of those new opportunities are, as well as answer some of those questions that you may have around that transition and what's going on there and how to kind of work through that process. Our presentation today, of course, is going to be from myself and Dad here at Molitor Wealth Management. I'm Parker, of course, and they also, Flexible Plan has been a big partner of ours with the Nissan 401k and some of the opportunities to manage the assets within the plan. And so Anna Kinsella from Flexible Plan is on the call with us today as well. And she'll be sharing a little bit about how those opportunities are going to look moving forward within the new 401k setup. Got to have our disclosures, of course, for compliance. Obviously, all that we discussed today will be for education purposes. And we do want to say that while we work with a whole lot of Nissan folks, we are not officially endorsed by Nissan nor Voya. We just have a lot of exposure to those plans and a lot of working knowledge from doing that for so many years. Now, moving to Voya, the first question we've heard several times come out of people's mouths is, well, who is Voya? What is that? And a lot of people aren't familiar with the name, but it's actually a very large publicly traded company. And they focus on retirement plans as well as investment insurance products. So you'll see a lot of different kind of divisions of Voya if you start looking into it. But really what we're going to be dealing with is the Voya Institutional Plan Services, which is the record keeper division of Voya. And the record keeper is just the kind of the group that's responsible for keeping up with all the details of the 401k plan, giving you access to it, providing education, processing transactions, all those different things that really you've been used to interacting with Vanguard to receive. Now that's all going to be happening through Voya. Of course, there's kind of a transition period with this happening, and the blackout period, we call it, is kind of that in-between time frame where it's moving from Vanguard to Voya. And they kind of shut everything down so that they can get it ready and kind of transition everything. So during that blackout period, which we've just kind of been going through the last couple of weeks, you may have noticed you hadn't been able to really log in and see amounts or allocations or anything like that. That started on June 13th. However, this week, they are completing the transition. Not necessarily June 26th exactly, but it should be coming out and finished sometime this week of June 26th. So here in the next few days, you guys should be able to have full access to everything again like you're used to, of course, on the Voya side now. Okay. Now, the good news is a lot of folks wonder, well, during that blackout period, I can't access it. I can't see it. Is my money still invested and growing? And yes, it is still invested. However, it was, on June 12th, allocation-wise, it stayed that way through the blackout period. So whether the market was up or down, your account was going up or down with it. The other thing is allocation stayed the same, but also contributions. So any payroll automatic contributions you had set up kept going in during that time, as well as the match from Nissan. So that's a good thing. We didn't lose any time there in the market or for contributions. Now, I kind of alluded to this earlier before we started the presentation with some of you guys, but probably been getting a lot of things in the mail about the move to Voya. And there's a few important numbers that you probably received as well. One is a PIN number, and you should have gotten that probably last week in the mail. The PIN number really is just designed to give you easy access to the new Voya website. So when you go to nissan.voya.com to register, you'll want to have that PIN number handy. And essentially the PIN number is going to allow you to kind of tie into your existing account that transitioned over and create a unique username and password that you can use each time moving forward to go ahead and access the account, much like you would have in the past through the Vanguard website. So if you haven't done that yet, find that PIN number, go to nissan.voya.com. It will ask you to click register and then kind of walk you through the prompts. You can put that PIN number in, create your username and password and whatnot, and then make sure you save those, because moving forward, that's what you'll use to access the 401k, to look at your balances, if we want to make any adjustments, if you want to change contributions, all that will be done through the website now. And if it's easier, you can also go through the livewellatnissan.com portal, and it'll link you over to Voya moving forward. Now, a lot of things are going to stay the same with the plan. I guess that's good, because, right, if it ain't broke, don't fix it. And Vanguard was working pretty good. There are a few changes as well we'll talk about in a second, and they're actually for the good. But a lot of things are going to stay the same. And some of those items are your account balance. Obviously, would have loved that to shoot up as it transitioned over, but no, those will stay the same. Of course, adjusting for fluctuations in the market during that blackout period, like we talked about. Your contribution election, whatever the amount was, if you had a 6% going in or 10%, that'll be the same and transition automatically to Voya. Investment elections, not only for existing money, but also new money, will also remain the same. So all that will transition automatically. And other important things like your beneficiary designations will stay the same. So whoever you had listed as your beneficiary at Vanguard will automatically carry over to Voya. Now, I think it's good to review your beneficiary designations every so often. So this might be a good kind of reminder just to do that, make sure it's still what you think it is and what you want it to be. But whatever was at Vanguard automatically transitions over to Voya for beneficiaries. And then if you have a 401k loan, obviously that balance will transition over, as well as any repayment schedule that you have set up and in place. So all that will stay the same and automatically transition over as well. One thing that won't automatically transition over, though, is your banking information. So if you have bank information, or had it, I should say, on file with Vanguard, and that would be like an ACH bank connection for loan repayments. Sometimes folks like to pay them outside of the actual 401k payroll deduction. Or if you had any banking information online for distributions out of the 401k, that will not transition over to Voya. So that, if you want to keep that in place, will need to be updated manually, if you will, once the Voya transition is complete this week. So just be aware of that. If that's something that you're utilizing, you want to keep in place, that needs to be updated. If not, if you're getting a distribution, let's say, and you don't update that, it's not that it's not going to keep coming to you, but it'll come to you via check. Not the end of the world, but maybe not quite as convenient either. So something to be aware of there. Now, another thing that's going to remain the same are the investment options. So all the funds that you're used to seeing in the core plan of the 401k will remain the same. We're still going to have target date funds, which we'll talk a little bit more about here in a minute, but those are kind of the default option if you don't choose funds yourself, which I know a lot of you are choosing funds yourselves or working with us to manage the funds for you. But if not, the target date fund is the default option, and it's based on your age, and it gets a little bit more conservative as you get older and closer to retirement. Of course, you can continue to pick your own funds, and those funds are going to be the same lineup that you're used to seeing at Vanguard, so not much is changing there. Voya also offers what they call their advice and guidance service, which is similar to what Vanguard offered for their kind of models that they manage and that you can enroll in. Voya will have a similar version of that you can take advantage of if you want. And of course, there thankfully will continue to be a self-directed brokerage account option. Now, Vanguard used TD Ameritrade to provide that. Thankfully, Voya also uses TD Ameritrade to provide that. And of course, if you're working with us already, you're probably pretty familiar with the self-directed brokerage account and TD Ameritrade. Using that brokerage window, we have access to hundreds of additional investment choices and options, which is obviously a good thing. Anytime you can have more choices available to you, that's something we want to take advantage of. And the other thing with this TD Ameritrade brokerage account at Voya versus Vanguard, while they're the same provider, you will have a separate or a new TD Ameritrade account number. So that's something else you should have received in the mail. If you already had the brokerage window through TD Ameritrade set up with Vanguard, it's going to also be available through Voya, but you're going to automatically receive in the mail a new account number for that TD Ameritrade brokerage window account. And if that's one that we're managing for you, we'll need to get that new account number for you put into the system so that we can keep track of that and keep trading and managing it. So probably got a PIN number already in the mail, as well as a TD Ameritrade account number. So if you're wondering why you're getting multiple numbers, that would be why. Okay. And we'll spend a few minutes here after we talk about some of these highlights of the transition of Voya, talking more about the investment options, and especially the option that we have to manage the 401k for you moving forward, much like we did at Vanguard. Before we go into that, though, I want to take a minute and pause here, and then I'll turn it over to Anna to talk to us a little bit about the investment options and how we can optimize them within the Voya 401k moving forward. But I want to stop here and see if anybody has any questions about any of those transition Voya highlights that we just went over. If so, you're welcome to unmute or type in the chat box and we'll address those. We can certainly follow up afterwards and address them as well. Okay. Well, I don't think we've got any questions at the moment, so I guess that's a good sign. Anna, if you want to take over, and I can run the slides for you as you're ready to move forward in each one. But if you want to introduce yourself and then tell us a little bit more about how we can get the most out of the 401k moving forward, I'll hand it over to you.
Sure. Yeah. Thank you. Thank you for joining us. It's been a pleasure working with Molitor Management, and we've had just a great relationship. And certainly the market over the past 18 months has been very tricky. It's actually the longest kind of sideways market we've had since 1948. So it's been a long, kind of painful road. So I'll talk a little bit about performance, but the important thing is, the fact that you guys have embraced the brokerage window, which is what we call the TD Ameritrade account, so that you have the advice from Parker, Chad, and his team, I think is really important. These are some of the questions that I hear, and probably Parker and Chad hear, which is, number one, do I have enough assets to retire? One of the funniest questions that I tend to get is, how rich are you in America? What does it mean to be rich? And it all comes down to, how much do you spend? That's the number one question. So it's all about having like a full financial plan in place, which I know without having a team to support you, it's really challenging to build a financial plan on your own. The other thing is, are my assets in the right place? One of the biggest questions, aside from number one, is what bucket of money do I use first? Not only from a tax perspective, but to make sure that that money doesn't run out. And so that's why all of those things kind of tie together into putting together a financial plan that can support you so that you feel confident going into retirement, knowing that you're going to have the goals that you want, the life that you want, and that your assets are going to last for whatever reason that is. If they're for yourself, if they're for buying a boat, if they're for leaving, for your family. And then again, what assets do I spend first? That's a really important question. And a lot of people will just make the assumption and start to spend based on really kind of, one of the things that we see that's a big mistake is what account has performed the worst or the most poorly, and they'll start to spend from that account. And that's a dangerous game, because you want to allow that account to recover, and you also want to look at it from a tax perspective and your financial plan perspective. And that's kind of why it's really important to have an advisor to protect yourself. I mean, it's just human nature to have kind of a reaction like that. So having a full financial plan and having the ability to contact someone when you have these questions is really important. In fact, I don't even have the ability to have a financial advisor on my 401k, and I'm in the industry. So it's just a really big great advantage that you have as part of the benefit working for Nissan. So just I think it's wonderful that you guys have embraced it. And I certainly think this change to Voya sounds like it will be somewhat of an easy transition, considering that you'll still remain at TD. Unfortunately, a couple of things will change, but the fact that you have, a whole team to support you is just a wonderful thing. Three things to consider when investing. This is something that I think we've all had to kind of remind ourselves about as of late. How do you make decisions about your investment options in your retirement? Again, it's very easy to choose kind of the low cost provider or the best performing provider. That's a dangerous game to play as well. One of the things that's really wonderful about the relationship that you have is you have a team of advisors that can help you kind of make decisions to make sure that you're diversified enough, but not over diversified. And they're taking a look at your assets outside of your plan, which is really important because a lot of times you don't have that opportunity. For example, I don't have that opportunity. I don't have someone who's kind of saving myself from myself when I'm making investment decisions within my 401k. So I think that's just really great. Traditional investment advice, efficient enough in an ever-changing market. So over the past 20 years, you're starting to see markets that have become incredibly more global. There's more access. So, prior to 20 years ago, people couldn't just jump into their 401k account on their own and make a knee-jerk reaction. And now everybody kind of has access to everything, right? So it's really important to make sure that you stick to your financial plan. Just let your advisor kind of run the show. They're the professionals. It would be a full-time job to keep up with these markets. They're changing so quickly, and you see these huge declines in markets and then these huge recoveries. So it's just really important to make sure that you stick to that plan. And I know that Parker and his team have done a great job of building the plan and trying to help you stick to it. And then, are you aware of the investment options? Obviously, you guys that are on the call have embraced this available option. I don't know if you know anybody else within your organization that would adopt this idea. I think right now it's more important than ever to make sure that you have the information to know that the past 12 to 13 years have been somewhat easy to make money. But just like anything, the market's going to cycle in and out of, growth. And I think the next couple of years are going to be challenging. There's going to be a lot of opportunity, but staying within like a Vanguard fund or a fund where you don't have someone who's monitoring the investments, you need somebody who's paying attention to where the growth opportunities are. And that's one of the things that our firm is trying to do. So target date funds. My father is actually a mechanical engineer and he works for Illinois Tool Works. I don't know if you guys have heard that, just being industry. But he was in a target date fund. He retired in 2020 and he was in a target date fund that he thought was going to protect him from what we saw was a very unusual behavior in the fixed income market. So as he got older, his equity positions declined and his safe investments or his bond investments increased. So it's all based on your anticipated year of retirement, and kind of your equity allocation will be higher because you have a longer time horizon to allow that to grow. And then kind of as you near retirement, you're going into these safe assets. The problem with that is, as we saw, fixed income is not necessarily as safe as it once was. There's so many kind of new assets that have come to market. Markets don't behave rationally. They never really have. But now that there are different threats to the global markets, it's really important to have a manager who can go outside of the opportunity of just stock and bonds. So I think in theory, target date funds are a really great option. In terms of execution, we've really started to see them fail and fail miserably. So my father kind of kept his allocation to try and see if it would kind of recover. Fixed income has really struggled. You're starting to see it behave a little bit more like it's supposed to, but I think it's going to be a really long time because of the Fed continuing to raise rates. So just understanding how target date funds work is really important. Most of the population in America is invested in 1 or 2 target date funds. It's funny because we see some investors that have 2 to 3 different target date funds because they're unsure of when they're going to retire. But what they don't realize is that they're actually overlapping and have a lot of the same investments, even though they feel like they have different investments. So it's just important to know kind of how those things work. And this is one of my favorite all-time slides. So although it feels very painful now, and even for me, I feel like 2008 wasn't that long ago, but it actually really was. A bear market is really defined by a negative 20% of a fall from the last market top, right? So that is just the standard definition of what a bear market is. One of the important things to know is that almost half the time, going back to really the early times of the stock market, almost half the time you're either in a sideways market or a bear market. So it's very rare to be in a true bull market. Although we've been a little bit jaded and a little bit spoiled over the past like 12 to 13 years, the market's doing what they're doing now is actually pretty standard. We just haven't had a lot of volatility. We had a very long run where you could pick pretty much anything and do quite well. So I think it's really important to kind of let logic sink in there and say, you know what, this is a little bit normal. It doesn't feel good, but it's a little bit normal. We've technically been in a sideways market, even though a lot of people say that we've been in a bear market and we're poised and positioned to be in some sort of recession. Our data actually suggests that probably won't happen. We'll probably have a little bit more volatility and we'll probably have some more fluctuation, but that's actually very, very normal. And this again just backs up the fact, going back a century, you can see that although this doesn't feel good and a lot of the media, or terror vision, as I like to say, likes to sensationalize what's happening, this has been the history of kind of market cycles over a century. And again, you need an investment solution that can help you navigate that 46% of the time where the market isn't just going straight up. And that's one of the intentions that we have. So if there is a sideways market or even a bear market, we try to find opportunities to make money during that time. If we can't find opportunity, what we try to do is protect you. Now, the past 18 months has been very tricky. We actually owned anywhere between 40 to 70% cash. So a lot of people said, well, why were you down so much? And it was one of the most unusual markets our founder has ever seen. He's been in the business for 45 years. He's owned our firm. It's private. He's owned our firm for almost 42 years. And he said last year was the most challenging market he's been in because all of the logic and the places where you would go and run and hide didn't really help. And even though we tried to time the market by saying, you know what, cash is probably like the safe haven, unless we would have stayed in cash the entire year or stayed in energy the entire year, even though energy had a ton of volatility, those are the only two places where we really could have protected clients. So it was just a really unusual market, very difficult. And this is just some math behind it. We often find that clients will tend to add and subtract declines. So if you're down 5%, you need 5.3% to get back to $1. And the reason for that is because once you start to decline, remember that your dollars are declining more and more and more. So that decline keeps impacting you. So it's almost kind of like compounded earnings, but in the opposite effect, where the more you decline, the more you need to make up. We really don't like to see clients over, a longer period of time decline more than 20%, because it just takes years and years and years to make that back. Now, you might see that in a short-term period of time, and that's okay. But over time, we don't like to see anybody, negative 25, negative 33%, because it just takes a very long time to make that up. And then this just talks about a little bit of the statistics behind how many bear markets there have been, and then how long it takes to recover. And most of the time you do see, a 30% decline in a recession over time. And how long does it take to recover? 3.5 years. Most people don't have that time or want to take that time. So one of the things that we like to do is just really protect you from hitting that negative 25, that negative 30%. If you hit it in the short term, we do have tools to help kind of enhance and catch back up. But over time, we don't like to see clients really hit those steep declines. And this is a really interesting chart that talks about the waiting game, right? So this talks about if you are an investor and you are waiting for a recovery. The bear market on the left-hand side will talk about the time period in which there was a bear market, and then duration in months is how long that bear market lasted. The percent of decline, so that how much did that market decline over that period of time, and then how long did it take to break even. So as you can see, September 29 through June 32 was pretty painful, and it's actually the worst we've ever seen. So we technically feel like we've been in a recession since last July. We actually are seeing indicators suggest that we're coming out of a recession. There's a lot of economists and a lot of media that tend to disagree with that. But we see a lot of reasons aside from the money supply and the Fed and some of the things that are going on in politics that are reasons to maybe see a little bit of a pullback. But we tend to believe that people that run companies are just as smart or smarter than the government. So we are actually very positive on the market right now. We're starting to see some more investment. And one of the reasons why you guys maybe saw a little bit of hesitation in terms of jumping in on that recovery as the market recovered this year is because we don't believe in just jumping back in. We want to make sure that the market's truly recovering, because the last thing we want to do is jump on a bandwagon and there's what we call a head fake, and then all of a sudden that wasn't really truly a recovery, and then your account declines again. So one of the things that we put into place is some technical indicators that make sure that we're truly in a recovery and that we're headed in the right direction. So you'll start to see performance really recover now. So this talks about, again, poor asset allocation and doing it yourself. There are people that fall into biases. It's called human nature. I do it myself. When I pick a stock that wins, I'm like, wow, I'm really just a great stock picker. I should do this more. There's examples of, you hear friends at the local drinking coffee or wherever you might go that say how well they've done, but they don't tell you who their losers are. And it's just really important, again, to have a team of people that are monitoring your portfolios, which is my team, and then also a team of people that you can help support your financial plan, which is why you have Molitor Wealth Management. But it's just such a great tool that you guys have available to you, because again, I wish I had it. I don't have it. I don't have the ability to have a financial advisor. Once I'm wealthy enough, hopefully I can join Parker and Chad, working my way there. But there's just evidence to prove that people that make investment decisions on their own. Even people that are in the industry will make emotional decisions before sticking to their financial plan. So that's kind of what this chart is suggesting. And then we talk about active management. So a lot of the opportunities within your plan are what we call ETFs or passive ETFs, where the manager will choose the investments. You'll hear buy and hold, buy and hold, buy and hold always wins. And it did for a very long period of time. There was a lot of reasons to support that, but the markets have changed so significantly that you do need a manager that will help you kind of navigate through some of these very tumultuous times. Now, do I wish last year we would have performed better? Yes. But we were the only manager in your entire lineup that did use as much cash as we did. It didn't work out as much as I would have liked, but we're not afraid to use cash, to use the dollar index, to use certain investments to try and protect you when markets get as tricky as they were last year. And then when the market starts to recover, we're going to make allocations to some of the winners, right? So right now, it just happens to be some of the technology holdings. And so we're putting a little bit more of the investment towards technology, and you'll see that change. We can actually change your investment portfolios as quickly as a week. So if we do run into a recession and I am wrong, we can actually put your portfolios to 100% cash. So there's not another manager that's available to you that would do that, that has done that. We actually did it for a period of time in 2008. We're not afraid to do that. The reason we didn't do it last year is because things didn't seem as poor as they did in 2008. It was kind of like a long draw, right? It was kind of like a slow decline, and it was a sideways market. So just know that if there is another situation, if there is some truth to these media speculators and some of these economists, just know that as quickly as next Wednesday, we trade on Wednesdays, your account could actually be in 100% cash and fully protected. Any questions so far? No, I've been talking a lot.
And besides cash, what can we do in say a down market to either protect or grow the portfolio?
Yeah, so there are different. So in 2008, for example, we used cash and then we used fixed income. We can actually use, if you're familiar with futures and swaps, we don't use options, but we use futures and swaps. We use pretty much any type of investment, with the exception of like a cryptocurrency or anything that's incredibly risky that doesn't have like a true valuation to it. So it just depends on where the opportunity is, hence the name flexible plan. If there's an opportunity that we find that might be a global opportunity, so a name that maybe does business in the US, but it also does business outside the US, we can do that, and we can do American companies. We try to leave it open so that we can take whatever the market's giving us and invest in that opportunity, if that makes sense.
Awesome.
So dynamic risk management is really a term that we coined, and it's basically taking instead of a single strategy. So instead of saying I own Apple, Tesla, Nissan, what we do is we take those holdings and then we run those through a screening process. We take a look at their balance sheet. So from an accounting perspective, how is the company doing? From a management perspective, do we like the way that the company does business? Are they, following the rules that they're supposed to be following? And then we create a portfolio of strategies, and instead of just saying we own Nissan, Tesla, and Apple, we own Nissan, Tesla, Apple, and we add other layers of different investments. Like I said, futures, we can use cash. And so there's different dynamics to our risk management tools, instead of just saying, like we were talking about earlier, you either get equities or if equities are failing and the market's going into a recession, you get bonds. We're trying to make sure that you have access to other assets in the market instead of just basically two areas of the market. We have what's called methodologies, and those methodologies, again, include any number of investments that are available in the investment universe that we feel are risk managed tools. Our portfolio team actually monitors the risk of our investments on a daily basis. So instead of at the end of the month or the end of the quarter, how did we do? We actually do that on a daily basis instead of waiting to see how things happen. Again, last year was very difficult. I know you guys were very patient, kind of waiting to see what happened. There wasn't a lot of winners last year. It was a very painful year. And also waiting kind of on this recovery. Again, the number one reason why we didn't just jump back into the market is because we wanted to make sure that this is a true recovery. So we're finding opportunities now to invest in that we feel will add true growth to your portfolio without taking on extra risk. Strategic diversification, again, same thing I've been talking about, where instead of just giving you a pool of stocks and a pool of bonds, we've opened up the universe to allow our management to go into different areas of the market to make sure that we're not limiting your returns and your opportunities. So, you know, one strategy might be equities. It might be, you know, the technology companies of the world. When those theoretically, when those holdings start to fail, like you might see here where there's a bear claw, let's say that's out of favor. To the right of that in the blue is your bull strategy that is doing well and is picking up the slack of those technology holdings. In a traditional bear and bull market, and even to a certain extent a sideways market, this works. Last year it didn't work as well as it should have, but this is just a graph that shows the difference between these holdings will perform well, and the analysis is done on, okay, you know, your purple section of the pie is technology. We know that that's an area of growth, but we also know it's incredibly risky. So the blue pie might be, you know, blue chip stocks, like the big companies like a Microsoft and Nissan, companies that have been around for a long time that we know can kind of hold up when perhaps the more risky stocks aren't doing well. Then the yellow might be something that performs in a bear market. Traditionally, that might be fixed income. It could be cash. So we're blending all of these different strategies together because when one goes out of favor, the other one is picking up the performance.
Anna, can you hear me?
Yeah.
I have a question. So how did your portfolio models do during 2008, since that was the worst year since the Great Depression? It's a good test period. How did the different models do? And do you remember, I know that's a long time ago now, like you said, but do you remember what strategies you used that worked? Did you go to gold or cash or short the market, or what did you do when the market was doing so poorly? I think the S&P was down 39% that year.
Yeah, good question. So in 2008, depending on the suitability, so depending on how aggressive you were, so the more aggressive portfolios were down under 8%. And then the kind of more conservative, so the balanced and the conservative portfolios were either flat or slightly up. So it was a totally different scenario because, again, we were able to go into fixed income, and that was a safe haven, right? We were able to use cash, and immediately we ran into cash. And then we started to see opportunities in bonds, and we moved into gold. We last year, thank you for bringing it up, because last year we were in different varying amounts of gold. That's another, commodities are another really big thing that we tend to use when the opportunity is right. And then we do have the ability to use the futures and swaps to get inverse or levered positions. So we did use that not only in 2008, but we actually used it at the beginning of this year. So yeah, good question. So the performance was better. The environment was very different. I mean, last year was incredibly difficult, and it was our most challenging year just from the perspective of not only deploying cash. It was the first time that we used the US dollar index when the dollar was recovering in our 41 years of history, almost 42. So we were trying to protect clients as much as we could, and the market was just like, you know, Monday through Thursday, the market was taking off, and then Friday it wiped all the gains away, and then the next week was totally different. You saw these rotations from energy being the you know, the best sector, and then the next month it would be the worst, and then it would be the best. So it was just such swift rotations in what was in favor in the market. It was very hard to navigate from a management perspective, from an investor perspective. It was just very difficult. So we like to talk about the investor gap. So if you think about when you go to a restaurant, or if you're a cook or a chef, or you know someone who's a cook, we talk about all the ingredients that you would use to make a meal. And some of the things that you do when you're a cook, right, is you try different combinations of things to find the very perfect recipe. And that's just an analogy that we like to use when we are exploring how to navigate through these markets. We do a lot of testing on any kind of strategy that we're going to come out with. One of the most important things for you guys to know is our founder starts every single investment with his own money, and our being employees, we're invested right alongside you. So I know exactly how painful it was last year. And one of the very important things when you start at this firm is you have to really believe in how we invest money and what we're doing, because one of the requirements is to have investments alongside clients, because our founder believes that we need to be right in the trenches with you. So just an analogy, hopefully it helps, but it's just something that we like to share with anybody who's an investor or potential investor. And then all of the disclosures. Our firm was actually voted one of the best places to work in Michigan. Our home office is in Michigan, so we are not a Wall Street firm by any stretch of the imagination. We are very much believers in our clients having the best exposure to investments that you might find at large institutions or very wealthy clients get. We believe that everyone should have access to those investments, and that's really one of the reasons our founder founded this firm. Very smart guy. He's a tax attorney. He used to be a securities attorney. So he's very dedicated to the industry and just has a real passion for that. We've won several awards and have tried to do the best for clients, and our clients are always definitely first. So aside from performance last year, we love to see, you know, continued support of kind of what we do and why we do it. And again, the nice thing about our waiting to step back into the market to make sure that this is a true recovery, you kind of touched on it, Chad, is the fact that we can use our futures and swaps, which are a very low risk opportunity, to add a little bit of leverage to catch up from being slow to jump back in. So this is just a description of kind of how you open an account. We probably don't need to go through this since you guys have accounts with us, but
yeah, I think most people have been through the process already of opening the self-directed brokerage account within the 401k. And obviously having us help them set up the flexible plan management. So I think that's one that is probably, well, we'll throw it out there for just a second, folks, and look at in case there's some on the call that haven't done that yet or just want to recap. But yeah, essentially within Voya, as it transitions from Vanguard, still going to have the self-directed brokerage account, and our team here at Molitor Wealth Management will help you set that up and then establish the connection with flexible plans so that we can employ their management strategies on your 401k.
Very good. And then your personal benchmark, which is also a really important proprietary tool that we developed. A lot of people will compare their investments to the S&P 500. If they have a fixed income or a bond portfolio, they'll compare it to a bond index. What we do is we take a look at all the different things that you own. So if you own technology stocks, that would be the NASDAQ index. If you own equity, that would potentially be the S&P 500, the S&P 1500. And then if you own any bonds, then we also add in a fixed income. Usually it's the Barclays Ag, but we blend all those benchmarks because we find that a lot of people will just say, oh, my portfolio versus the S&P 500 when you don't own just S&P 500 stocks. So it's important to make sure that you're doing like an apples to apples comparison. Most managers don't do that. They just throw up a bunch of indices and then you're kind of left to figure out where your portfolio falls in line. So the on target monitor is really helpful because it's truly a custom benchmark according to what you own in your portfolio. Does that make sense?
Makes sense to me.
Okay, good.
Yeah. So we're getting close to wrapping up now. And for those of you that have been on the call the whole time, I know we've had some join late as well. Just to kind of recap everything. Probably the easiest thing, we'll send out a recording and so forth. But if you go to nissanretirement.com, that goes to the Nissan information on our website. And we've got a lot of the different details that we've talked about here today and some other details as well that we didn't have time to cover today that you guys can review there. Also, if you haven't already scheduled or had your personal retirement overview meeting with us here at Molitor Wealth Management, definitely recommend you do that. You can either go on the website there at nissanretirement.com and schedule there online, or you can give us a call at the number listed here on the screen and we can schedule that for you as well. And really, as Anna alluded to, the 401k is a very important part, but really just one of many parts in a successful financial plan and retirement plan. And so in that pro meeting, we help you evaluate your current condition financially across the board, not just the 401k, but any other assets you may have, any liabilities, income needs, other resources, and risks that may need to be addressed. And we can help you project out different scenarios. Say I want to retire at 60 or 62 or 65. What are the differences? What does that look like? And when's the best time for me? Obviously, looking at the 401k and helping you optimize that will be an important part of the process. But also the pension plan with Nissan is an important part. And one of the wonderful benefits that you guys receive there as employees at Nissan and eventually retirees at Nissan. So that's a big deal and something we want to help you not only understand, but also we can project out the amounts at different ages and what that will be and show you how that works with the different distribution options and so forth. And then we give you a list of action items to go home and work on. We can help you implement those as well. And certainly when it comes time to retire, we help walk you through that process from the first step of getting with HR and getting a separation date to the pension paperwork to retiree health insurance and rolling over 401ks if you decide to do that and so forth. So a lot of steps there, but we can help walk you through that. And for our Nissan clients, we do not charge for that pro meeting or helping you with any of those different things I just mentioned. So that's something that's a very valuable resource that we're happy to extend to our Nissan clients in that community there that we work with so regularly. I'm going to put up the disclosures for just 1 minute so we have it, and then I'm going to come back to that screen. For compliance reasons, we'll put this up there and let you guys see that for a second. But essentially, we've reached the end of our prepared remarks. So I do want to open it up real quick. Again, if anybody has any questions and they want to unmute, they're welcome to ask that way, or if you want to put it in the chat box. And we'll just give it a second here to see if anybody has any questions. Also, I know we had some folks jump on the call late, and I know we had a little bit of some technical issues with registrations. Had a lot of spam registrations, and our filter was filtering out most of those. But if you got filtered out by mistake and you're a Nissan employee who's on the call today and you still need to get a Grubhub code, just email me. You can send it to parker.molitor@lpl.com. and we'll get that taken care of for you. And I'll put that in the chat box. So you guys have my email, and then we'll get you taken care of here after the call. If for some reason that Grubhub code got missed or there was some issue with your registration. So.
Yeah, one of the things that I have always been really impressed with your team is, instead of, your retirement plan telling you when to retire, you guys take charge and make sure that the client gets to choose when they retire. And that, I think that's just really meaningful and special and very rare. And so kudos to you guys, because I think that's a reason to come in and do a pro with you.
Yeah, definitely. I mean, the numbers have to work. Obviously, we can't do magic, but if the numbers are close, we can certainly help you achieve those goals and retire when you want to retire and maintain the lifestyle that you want to maintain. And so that is an important reason to not only have that pro meeting around retirement, but even if, you're 5 and even more years out from retirement, starting sooner and planning ahead will give you that much more flexibility and leeway to achieve those goals, certainly. It's a great point, Anna. All right. Well, I don't think anybody has opened up their line to ask any questions, and I don't see any in the chat box. I guess that means we did a really good job or a really poor job of describing everything. They either got it completely figured out or they're so confused they don't know what to ask. I think it's the first. Hopefully everybody understood that. It made sense. Feel free to email questions afterwards if you think of them as well, or follow up with us one-on-one to discuss any of this and how it's going to impact you. If you do have those new TD Ameritrade numbers you got in the mail, please make sure you reach out and get that to us so that we can get that updated in your file if you haven't done so already. I know several of you have already. But with that, Anna, do you have any other closing comments, or Chad, do you have anything you want to say?
I don't. I just want to thank you all for joining us. I hope you enjoyed lunch. I know it's taking some time out of your day, but I'm here via Parker if you have any questions, and thank y'all for your support. And I hope everybody has a very nice rest of their summer.
Mm-hmm. Yeah. Thank you everyone for joining. It was a lot of good information.
Yeah, certainly.
Hey, Parker, I got one question right quick before we get off.
All right.
When we went over everything, when I set my 401k up with y'all, I remember being a 4% penalty. Is it on retirement or 401k if we leave early?
Yeah, great question, Mike. So what you're referring to is the age discount that is applied to the pension plan. So not the 401k.
Okay.
There is something with the 401k I can hit on here in a second, but the 4% is a 4% per year actually prior to age 62 on the pension. And they call it an age discount. You can call it a penalty, whatever you want. But let's say you retire at 60. Well, you're going to get an 8% discount applied to your pension benefit versus had you waited until 62 to start taking it. So however many years early, early being prior to 62, multiply that times 4, and that's the discount that would be applied to your pension benefit.
Okay.
Yeah.
But is there any penalties on the 401k if we leave out early?
So with the 401k, the only thing to kind of be aware of penalty wise, if you will, is really a tax rule. And prior to 59 and a half, if you take distributions from an IRA, you do have a 10% tax penalty unless you do what's called a 72T distribution. And we can talk a little bit more about that in detail if that's something that may be a fit for you. There is a way around it. You just have to follow certain rules and jump through a couple of hoops. Now, if it's money that's left in a 401k, if it's left in Voya, and you retire between 55 and 59 and a half, you can actually take the money out. It's called separation from service. It's a IRS rule that allows you to access money directly in the 401k. So you pull it straight from Voya to your checking account in this case, and that 10% penalty is waived as well in that case.
Okay, 59 and a half and after, there is no penalty on.
After that, you can do whatever you want with those funds. There's obviously ordinary income taxes, but nothing as far as a penalty tax or anything of that nature.
Okay.
Yeah, good question though. Any other questions before we wrap up here? All right, I think that covers it all. Appreciate everybody being on the call and joining today. Hopefully you learned a few things. And if you, again, have any other questions or need any other assistance, please reach out to us and we'll be happy to help you. Otherwise, we'll talk to you later.
Thanks, everybody.
Bye.
Thank y'all.
Sure.